This video is an Uncovered Japan company research report on Yappli, ticker 4168. Yappli gives Japanese enterprises a no-code way to build and operate branded mobile apps, websites, employee tools, and mobile ordering. The core business has unusually strong retention and has crossed from cash burn into profit, while the shares trade at a low earnings multiple. The question is whether its newer products can restart growth without weakening that high-quality core. The investment snapshot is unusual for a small Japanese SaaS company. At the report date, Yappli traded on about 9.7 times forward earnings. Recurring revenue was 81.6% of sales, monthly churn was just 0.92%, and fiscal 2025 return on equity reached 32.7%. But the market is balancing those strengths against decelerating growth, execution risk in newer products, and a thin float with a high margin buying ratio. Yappli's load-bearing idea is no code. A retailer, restaurant, or other enterprise can launch and update a branded app without asking engineers to rebuild it for every campaign. Teams can change content, manage loyalty features, and send push notifications from the platform. The established app product is the engine. Around it, Yappli is building 3 expansion bets: employee engagement through Unite, website production through WebEx, and mobile ordering plus Line mini app services. Revenue grew from 3.26 billion yen in fiscal 2021 to 6.06 billion yen in fiscal 2025, a 5-year compound rate of 13.2%. More important, operating profit swung from a 930 million yen loss to an 880 million yen profit. Company guidance for fiscal 2026 points to 6.8 billion yen of revenue and 1 billion yen of operating profit. That margin repair is the central proof that the model can scale. The balance sheet now looks very different from Yappli's loss-making years. The equity ratio recovered to 59.5%, and return on equity reached 32.7% in fiscal 2025. The company was effectively debt-free, with about 1.04 billion yen of net cash. Some net income movements reflect one-off charges and deferred tax effects. So operating profit is the cleaner measure of underlying progress. Cash flow confirms the turnaround. Operating cash flow became positive in fiscal 2024, and free cash flow followed in fiscal 2025 at roughly 690 million yen. This matters because Yappli can now fund product expansion and shareholder returns from the business, rather than from repeated balance sheet support. Fiscal 2025 also brought the first dividend and first buyback, for a combined payout ratio of roughly 34%. Yappli's moat is not simply a drag-and-drop interface. Monthly churn of 0.92% indicates that customers rarely leave once an app becomes part of their marketing workflow. Yappli also accumulates operating know-how across launches, campaigns, and app store processes. Enterprise buyers value reliability and ongoing support, and monthly average revenue per user of about 460,000 yen gives Yappli room to deliver that service. Those factors make the installed base harder to displace than a simple software feature list suggests. Management's longer-term ambition is 10 billion yen of revenue by fiscal 2030, compared with 6.06 billion yen in fiscal 2025. Reaching it requires more than the mature app core. Unite, WebEx, mobile ordering, and Line mini apps must add a second growth leg. Japan's digital transformation spending and labor shortages help the case, but the newer products are not yet proven at the same scale or retention level as the core platform. The bear case is concrete. Revenue growth has cooled from 36.5% to 9.9%. The multi-product strategy may fail to produce enough culling. While generative AI is double-edged, it could make Yappli easier to use, but it could also reduce the differentiation of conventional no-code tools. Finally, this was a roughly 9.1 billion yen microcap, trading about 58,000 shares a day, with a 12.7 times margin buying ratio. At 704 yen on the report's price reference date, Yappli traded at 9.67 times forecast earnings. That was below its recent historical reference, near 14 times, and roughly half the report's sector comparison of 18.4 times. Price to book was 2.88 times, which looks less demanding beside a 32.7% return on equity. The discount says investors expect growth to stay slow or question the durability of current profitability. The report's author scenarios are deliberately wide, not price targets. By fiscal 2028, they frame roughly 12% downside in the bear case, 84% upside in the base case, and 211% in the bull case, from the reference price. The useful lesson is what drives the spread. Whether revenue reaccelerates, margins hold, and the market eventually rewards the cash-generative SaaS core. Investors should update every input rather than rely on these static estimates. Yappli's scorecard is balanced. The strengths are a sticky no-code core, recurring revenue, strong return on equity, net cash, positive free cash flow, and a low forward earnings multiple. The weakness is that the market needs evidence that the newer products can restart growth. The cleanest indicators are monthly churn, new product contribution, operating margin, and liquidity. This is research for education, not investment advice, and the figure should be checked against the latest company disclosures. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.